and welcome to Macros with Mythili, the ET Now show that takes a hard look at all the major macroeconomic issues and developments in India and overseas. Well, in this edition, instead of looking at past developments, we're going to try and bring you a flavor of what lies ahead. In fact, in the very next week. By the middle of next week, we'll know exactly how the 5 wise men and 1 wise woman who constitute the MPC have voted. Given the complexities of the macroeconomic scenario today, both domestic as well as international, we can be sure that whatever decision they take, whether it is to hike policy rates or maintain status quo, there will be enough critics. But then that's part of the price that you pay for being a member of a committee that seems to wield an extraordinary amount of clout. In the meanwhile, in the run-up to that all-important decision, in this edition of Macros with Mythili, we're going to try and understand the macroeconomic environment against which the MPC, the Monetary Policy Committee, will have to take its decision, and then try and come up with our own policy suggestions with our panel of experts. I have with me Abhik Barua, Chief Economist, HDFC Bank, and Swagato Bhattacharya, Chief Economist, Axis Bank. Welcome to the show, Abhik, Swagato. Well, since no policy can or rather should be framed in a vacuum, let me start by asking both of you in turn, how would you describe the macroeconomic scenario today? And since monetary policy must always be forward-looking, how do you see things pan out, say a year from now? Remember, this time next year, we would already have had elections and there would be a new government in place, and both these developments would have a major bearing on the health of the economy. So let me start with you, Abhik. Your views on the broad health of the economy in the future as well as present. We'll get into the sector-specific details a little later, but for now, how do you see the macroeconomy?
Well, it's not doing too badly. I think despite some of the macroeconomic numbers and industrial production and so on that we've seen reasonably recently, I think there is some signs of traction building up in the economy. Some sectors like cars are doing well, and the food situation seems to be sort of under control. Food prices have been soft. The rupee, after getting battered for a couple of months, I think has stabilized. Oil prices have also fallen into a range which is broadly in line with our tolerance or comfort level. So it's not doing too badly, but I think there are a lot of risks going forward, and you mentioned the elections and so on. So I think at this stage, it's looking good.
Swagato, would you agree with Abhik? Because remember, he started off by saying not doing too badly. But remember, this is a government who is going into an election. So would not too badly be good enough? And remember, as an argumentative Indian, you're not expected to agree completely with Abhik. So please feel free to disagree.
No, but I mean, facts are facts. So I think Abhik is completely on the ball, that we are not doing too badly. In fact, there are enough signs now of a growth recovery. So, I mean, our GDP numbers at 7.4, 7.5, whatever the numbers are. And more importantly, you are just about beginning to see some nascent signs of investment recovery. Of investment reviving, which has been very, very stagnant for a whole number of years. But together with this, there are enough signs. I mean, capacity utilization is slowly increasing. Demand seems to have come back into the system, as Abhik says, that if we believe that demand for automobiles, two-wheelers, etc. But however, having said this, I do want to emphasize that we are at a very nascent stage of recovery. A lot of the automobile two-wheeler sales is finance driven. I mean, particularly from non-banking finance companies, the amount of finance that is available for consumer durables and for automobiles, that's one major factor driving sales. So I don't know how strong the intrinsic demand for these products are. But having said this, there is a nascent recovery even in investment. But together with this, global domestic risks have really risen, have really expanded the whole spectrum of risk and the intensity of risk. So it's a very, very difficult situation now. You need to nurse this recovery. And coming back to your last point, that are we at a level of growth which is compatible for what is required? No, we are getting there, but we still have a way to go.
Obik, we've been hearing about this nascent recovery for quite some time now. So what do you think should weigh more with the MPC, the domestic economy with this nascent recovery, or what's happening in the rest of the world? I know one can't see either in a vacuum at all, but even so, do we really have the luxury, like the US Fed, of virtually ignoring what happens in the rest of the world? And given that there are so much uncertainty and broadly the world is tightening, can we really afford to ignore that, Obik?
No, I don't think, as Shogoto pointed out, and I'm sorry I'm agreeing too much with him, it's really a very fine balance. And I think just paying heed to the global risks does not necessarily mean that you are not supporting the domestic recovery. You might actually need to take action to fend off some of the, the pressures coming from the global side. For instance, a sharp fall in the rupee that could have major effects on domestic liquidity, interest rates, and so on. So you need to ensure that that doesn't go out of control, and also sort of, mollycoddle this nascent recovery a little. So it's not a simple binary choice. Is perhaps the biggest threat that we are witnessing and will witness going forward, given the talk of the currency wars and so on. So managing our currency risk as a monetary policy authority, I think should be quite close to the top of the list. And for that, you might need to take some decisions which might look a little unsavory, but are actually good for the economy in the slightly longer term.
Swagato, for now, I'm sure you'll agree once again with Obik that domestic concerns must always outweigh concerns about the international developments. That's fair enough. But what is it that worries you most about the domestic economy? The failure of investment and hence of growth to really pick up in a big way? Or are the worry is about the incipient signs of rising inflation, because inflation has been picking up, and maybe for a country like India, it's easier for us to live with slightly lower growth, but much more difficult for us to live with higher inflation, particularly in a democracy going in, once again, I repeat, for an election.
So I think I completely take your point that maybe inflation, and that's the rationale for an inflation targeting central bank. That inflation, after all, is the final outcome of all the other factors, whether it be the currency, whether it be growth, whether it be investment, capacity, etc., will all show up finally in inflation. But there are a couple of points on this. That, I mean, your point one, that are we in an asymmetric environment with the global economy? That is to say, global central banks are raising rates. Actually, only one global central bank is raising rates. Nobody else is. My argument to that is our real interest rates, which is what, from an economics point of view, even if not in the real world, the real interest rate in India is certainly significantly higher than it is even in the US, the hiking central bank, the hiking global central bank. Should we worry more about inflation than we do about growth? Of course, I mean, there are other supply factors like the incipient increase in the MSP, I mean, minimum support prices, that's likely to come about in October, November, December. So there are some supply factors, maybe to a certain extent oil and commodities prices. But inherently, is there enough sign of growth that corporate pricing power has come back or is likely to come back in very rapidly, and that adds to the known sources of inflation? So that's the critical factor. That's what analytics and analysis now needs to figure out, that are we at a level of growth where there is sufficient growth momentum, there is sufficient endogenous acceleration in the growth process that imparts pricing power to corporates, and that adds to inflationary pressures. Other than that's the inherent demand inflation that is so dangerous. My own sense is that at this point there is growth that needs to be nurtured, nascent growth that needs to be nurtured, and it's not sufficiently intense to be able to create an unmanageable problem of inflation.
Yes, one would agree with you that certainly our potential should be much higher, but the question really, Obik, is what is the role of interest rates in pushing investment or growth? Especially because Swagato spoke about real interest rates being very high. I'm not so sure, because if you look at CPI at close to 5% and what the banks give you for 1 year, or you look at the RBI repo rate, the real interest rate doesn't seem anywhere near that 2% or even 1.5%. So that is my first question. Secondly, what if anything has really changed, specifically since the last policy, that in your opinion the MPC must place special heed to and maybe rethink their stance, or perhaps not rethink at all? Obik?
No, I think a lot of the risks that were kind of up in the air during the last policy have now kind of crystallized. I mean, there's clearly a risk, for instance, from higher procurement prices, and that can be a very big risk because that has a knock-on effect on a lot of things like wages, not just agricultural wages, but also wages in the industrial sector, because it's a primary wage good. So I think these have become more clear. Whether they need to react to this immediately or not is a different issue. To the issue that Saugata raised about pricing power, well, if you go by conventional measures of demand-driven inflation, which is sort of the core inflation where you strip out stuff that's influenced largely by supply factors, that's high and kind of rock steady for a while. And that prima facie, and I don't think the core inflation really reflects the entirety of the pricing power story, but it is some kind of a gauge that you can go by. And I think I go back to the issue of currencies, and I think just to finesse what Saugata said, that it's just one global central bank that's raising rates. That's not entirely true if you bring in the emerging markets, and if you see the response of banks, central banks like the Indonesian central bank or the Malaysian central bank or the Philippine central bank, everything has been driven by the need to ensure that the currency doesn't depreciate much. And I think principally the story that monetary policy has to pay heed to at this stage is the pressure on the currency, and a lot of the interest rate decisions would rest on the need to and the imperative of defending the currency, because the currency is not not a standalone market. It has an immediate impact on inflation, on interest rates, and so on.
Oh, absolutely. Or we could raise the point of what economists call the impossible trilemma, and that's something that we really will have to battle with. And you also spoke about the risks since the last monetary policy statement having been crystallized. Now, I'm not sure we can use the word crystallize when you have somebody like a President Trump in the White House. Nothing is crystal clear or crystallized as far as he's concerned. But I'm afraid it's time for us to slip into a very short break. So please do stay with us. We'll be back very soon. Welcome back. You're watching Macros with Mythili. I'm in discussion with two eminent economists, Saugata Bhattacharya and Obhik Barua, to find out what is the macroeconomic situation as they see it today, and what is their sense of what the Reserve Bank of India, or rather the MPC, the Monetary Policy Committee, is likely to do when they meet and announce their statement, finally announce it on Wednesday next. Saugata, did you agree with Obhik entirely that the risks have been crystallized, and you also feel that the currency situation is something that we must pay heed to? But what is the way you can handle the currency situation? The interest rate defense is a classic defense, but is that what we wish to do right now, Saugata?
So, two parts. So, the first question, have these risks crystallized? To a certain extent, one of the major risks that had been flagged over the last 2 or 3 policies, what the policy would be, what the actual announcement of the minimum support prices for the Kharif farm produce. So that actually has been actuated, even if it will take some time to implement. I mean, it will only happen in October, November. And even that we do not really know. I mean, at the most, if you just look at the CPI numbers, it will hit about 110 basis points. I mean, if you take the actual prices that are prevailing in the markets now, about 50 basis points, maybe it will impact 30, 35, 40 basis points. So that's one part which is definitely crystallized. Nothing else has changed since the last June policy. Oil is actually lower than where it was. Commodities prices, metals, after the announcement of the trade wars, the tariffs, together, commodities prices, metals prices has actually come off about 10, 15, 20% across the range of commodities. So, and remember, so all of this is definitely impacting the currency. So now getting into Obhik's domain on the currency management aspect of the central bank. Of course, I mean nowhere does currency management actually figure in any of the monetary policy statements. Obhik knows we had a discussion on this. But together, remember what has happened to the Indian rupee over the last year. till January or February this year, the rupee has moved in line with the overall EM basket, so emerging markets currency basket. It has almost entirely been a dollar story, which way the dollar moved against the developed market currencies. From about February, after the PNB scam, after that, I mean, there's been a divergence. We have underperformed the Asian currencies. Other currencies have gone all over the place: the Turkish lira, the Brazilian real, the Russian ruble, all of those currencies, the Argentinian peso, all of those. However, at the end, over the last month and a half, a new threat to the currency has emerged, which is the Chinese yuan. Now it's the CFET's basket that they target. And believe me, the rupee has completely moved, almost 101% correlation with 100% correlation with the Chinese yuan. My own sense is that the RBI is moving interest rates or trying to intervene in the forex markets is not going to do anything except at the margin for moving the Indian rupee. It's not. It's going to be a matter of how the dollar moves, and now more importantly how the Chinese yuan moves. I think, as Obhik very rightly pointed out, what the other emerging market central banks are doing are trying to put in place reforms. And in India's case, I think the biggest reform that can be done is to push growth forward. And if you push growth, that will automatically bring in more capital. Maybe not portfolio capital in debt, but definitely portfolio capital in equity. So I think that's the critical thing that we now need to do to try to figure out various instruments, various levers that we can use to try to promote growth.
Which is true, but growth is a far more difficult thing to promote, I think, than moving interest rates up and down, which is what brings me to my next question, Obhik, that the MPC has often been accused of viewing the shift to inflation targeting too narrowly and in the process relegating growth concerns to the back burner. Do you share that view, number one? And this time around, should they pay more attention to the fact that the mandate given to them has been flexible inflation targeting and not react to the likelihood that inflation could be perhaps in the region of 5%, above the midpoint of 4% that the RBI seems to have stuck to in the past? Or do you think that we don't have that luxury now? We've missed that bus when we could have utilized that flexibility, and for now you have to focus on inflation. Obhik?
Well, I think, Mythili, you've answered your own question, and I completely agree with you. And I have been a very, somewhat vocal but inconsequential critic of the current inflation targeting regime, which, I think one of the most prominent monetary economists, Michael Woodford, said that inflation targeting invariably tends to become, when it's implemented, becomes a caricature of what it is meant to be. And I'm not being disrespectful to the RBI and the MPC, but I think they have taken it. I mean, there are degrees of freedom which are even mandated to them, the plus minus 2%. And I think instead of obsessing over a particular number, which would be very difficult to achieve given the myriad supply constraints we have in things like services and so on, we might want to follow the textbook, contrary to what Shogato said as far as currencies are concerned. So I think we are dealing with a very specific issue, but I completely agree that we've taken the inflation targeting thing a little too far and taken it a little too literally.
Too literally, but that's what happens when you put 6 economists into a room. So Shogato, as a fellow economist, what would you say? Would you agree with Obhik that we tended to view inflation targeting too narrowly in the past? But today, do we have that luxury of being a little relaxed about it? Or is that time for relaxation and flexibility over in today's scenario? Shogato?
So, I mean, this is not good for television, but I agree with very, very substantially with both of you, and particularly with Obhik when he says that there needs to be an element of flexibility in targeting. Remember that, I mean, it's all very nice to talk about inflation, but the first thing is to be able to predict inflation properly going forward. So as of now, we know that inflation from July, the CPI prints are likely to come down, then go up again. Just look at the RBI's 4.8 to 4.9% CPI inflation prediction for H1 of this year. We are likely to get about a 4.6. Then 4.7 close in H2, and then we are seeing about a 5% inflation in FY20 going forward over the next year. Now, how much of a threat is this likely to be, given the trade-offs that we need to look at in terms of growth, as all of us agree that, I mean, growth is is one of the primary defenses for a currency, and the currency is a very good indicator of the economic, of foreign investors' perception of an economy. So how much is growth, and how much would you sacrifice in terms of the deviation of your target from the actual predicted inflation? And predictions are so important at this point in time. So if you read that, a 5% FY20 together with all the risks, I think at this point in time, it's, I think, important to let the growth get a chance, so to say, and particularly given the fact that there's been such a de facto tightening, monetary tightening, banking, credit tightening in the markets with market interest rates, with all the regulations that are now in place, with the amount of liquidity, effective liquidity that is now in place. I think all of those would need to inform the MPC's view on how much more repo rate tightening is required in the system.
Okay, if I've understood both of you right, Obik, I think you're suggesting perhaps the tightening may not be so bad, whereas Sogato seems to suggest that status quo is the right way to go, if I've understood you rightly. Please correct me. But if that is so, can I now move on beyond rate action? Let me shift to the stance. What, in your view, would be the right stance? Should they stick to the neutral stance that they had before, or is there a case for moving to a more hawkish stance, even regardless of what happens to the rates, whether you opt for status quo or whether you hike? So what is your call, hike and hawkish, or hike and dovish, or hike and neutral? What is your call? Then I'll turn to Sogato.
No, actually, I think you partly misconstrued me. I was just laying out as the background and the broad brush strokes of the picture that the RBI is confronted with. I think they could afford to wait and watch this time, and flag all the use all the red flags they have to give the forward guidance. But I would say hold and hawkish is my call for the policy. Okay,
and Sogato, will you agree with that, or would it be hold and hawkish or hold and neutral?
No, so I mean I think they will use all three. I hope. So this is what I would do. I mean, I know this is pretentious, but this is what I'd do. So hold, exactly as Obik says, wait and watch, because nothing has changed from the June policy. Hold. Two, if I do not hold and I hike and I still maintain a neutral stance, that I think is a very signal, inconsistent outcome of policy. You cannot have two back-to-back hikes and still have a neutral stance. It's not. I think a hike and a tightening stance I think is an overkill at this point in time. So I would use a hold rate hold. Markets have already tightened. Maintain a neutral stance, wait and watch, see how things go. It's very fluid, and maintain a hawkish tone to the policy to give a signal that with the slightest perception that purchasing power is tightening, that other exogenous factors are coming in, I'll hike.
Okay, so both of you are in agreement over there. That's interesting. But Obik, actually the cost of credit and the availability of credit are two sides virtually of the same coin in many, many ways. Both are important, not only for growth, but also for determining the overall availability of funds in the system. Does the RBI in the past few months seem to pay less heed to the implications of poor credit offtake on the availability of the funds, and think that its OMOs, whether it is durable or short-term liquidity, would be adequate to address this shortage? Is there a contradiction between the recent OMOs pumping in liquidity and the overall tightening stance that the bank seems to be hinting at?
Well, I think they have stuck to, I mean, there are two facets, I think, to neutrality as I understand it. One is the rate stance, and the other is their stand on liquidity, and they've kept it close to a zero balance on the LAF, which means that the banking system is neither a net borrower or net lender from the system, and that has an impact both on the quantity of credit that can flow through the system, as Sogato had pointed out, and also the price of credit, again something that Sogato mentioned. So I think the RBI, and you have the various structural factors of large NPAs, the PCA, banks not being able to lend, and so on. So there is a shortage both in terms of the availability and a rise in price in the price of credit. So I think the RBI is sort of doing a lot of tightening, through the back door, to use an inappropriate and expression, but I couldn't think of anything else. But that's what they are doing. So there is a lot of implicit tightening going on.
So, Saugata, what can we do to improve availability? Price is one thing, and both of you are agreed that yes, there is no case right now at the moment to hike. That would send a wrong signal. But can we do anything about availability, and is the MPC cognizant of that need?
Well, yes, I think they have. I mean, because their monetary policy operating procedures mandates that their short-term rates, overnight rates, are very close to the repo rate. So that they have been doing that. One obvious way of mitigating the liquidity tightness, Abhik is completely right that they have been using liquidity as a means of transmitting even whatever status quo repo rate signals into markets. I think a more generous and probably a certain degree of pre-announcement of an OMO schedule might actually cool markets a little bit, provide more comfort, liquidity comfort in the markets. Abhik is completely right that, I mean, together with this liquidity, actual cost of funds for banks has gone up. And even more worrying, I mean, it's not just the liquidity and the rate signals. There are other regulatory measures that have now come in. Compliance with these regulatory measures of LCR, the liquidity cover ratio, the NSFR, net stable funding ratios, the need to provide for bad loans, etc. That's really squeezed the liquidity, actual effective liquidity. So effective liquidity is even tighter because you cannot move instruments. I mean, use your SLR funds to borrow from the LAF because that will take down your LCR ratios. So net, everything has become far more tight than is immediately apparent from the, say, the LAF ratios, etc.
Okay, but I'm afraid this has been a very interesting discussion. We actually have two economists agreeing with each other. Unlike poor Churchill, who wanted, looking for a one-handed economist because he couldn't find the economist giving any clear opinion. We actually have a very rare situation of two economists agreeing with each other. Both agree that it should be status quo, and if at all, a movement toward a hawkish stance. But thank you very much, Abhik and Saugata, for joining me in this discussion. Thank you also for watching. Remember, we'll be back next week with yet another edition of Macros with Mythili. Till then, it's thank you and goodbye from all of us at TT Now.